Hello, everybody. It's great to be here one more time today. My name is Gary Fowler. I'm the CEO, president, founder of GSD Get You Done Venture Studios, a premier AI and quantum venture studio located in the heart of Silicon Valley. We are a family office. We have a PR and marketing group that works with our startups and also a software development group focused on AI and frontier technologies. So I want to welcome you each to GST Presents Top Global Startups. As I said, I'm the host, and today we're diving into a topic that is becoming mission critical for every founder, CFO, operator, and enterprise leader in 2026. Strategic working capital, unlocking the critical liquidity growth. In an environment where capital efficiency matters more than ever, growth is no longer just about revenue. It's about liquidity, resilience, smarter payment structures, and building a business that can scale without choking its own cash flow. Too many companies focus on top line growth while hidden inefficiencies inside permit terms, receivables, payables, and supply chain finance quietly drain flexibility and slow expansion and slow innovation. My guest today is Oliver Belin, who is a has 2 decades worth of experience across supply chain finance, trade finance, and credit finance. Over the course of his career, he's held roles with firms including Prime Revenue, GSCF, Sumitomo, Mitsui Banking Corp, and he also founded Swiss Commercial Capital, which was later told to a bank and today leads Calculum, a company focused on analyzing, optimizing, and negotiating payment terms through data and AI. He's also the author of books on supply chain finance and an instructor with the New York Institute of Finance. He's spent years at the intersection of finance, supply chain strategy, and technology, helping organizations understand that working capital is not just a finance metric, it is a strategic growth lever. And in today's market, that insight may be the difference between companies that merely survive and those that compound advantage. With that, I'd like to introduce Oliver Belin to the show. How you doing today, Oliver?
Good. No, thank you, Gary. This was a long introduction about myself, but yes.
Well, you have a lot of stuff out there. You've been around a few years, just like me. uh, and I wanted to make sure I do it justice.
Yes. No, it was good. No, very good. Yes. So
You
this
know,
is
you
now my.
you
Go
spent
ahead.
decades in supply chain finance and trade finance. What pulled you into this world, and what made you realize working capital was such a major strategic opportunity?
Like like many other things, I studied in Switzerland, and then actually I wrote my thesis on supply chains in Asia in the food and beverage market, and then I got my first job in this working capital finance space where I started as analyzing credit risk of obligors and organizations across the world. And then I realized that this is something, and this was long before, COVID, where people realized how critical supply chains are and disruptions. So this was in the early 2000s. So yeah, I found it fascinating how supply chains, where people take it as granted, it's really affecting everybody's product, everybody's life, every country. So yeah.
I mean, the thing is, look during COVID, right? We had a lot of problems with trying to get the right product at the right place at the right time. And yesterday I had another supply chain company come in and connecting the dots of these disparate systems. I mean, they're not connected. And then the other thing is you got other kind of issues because you got cultural nuances where some places you have to pay a little something under the table to make sure it goes through, right? And where do you put that on the in your accounting?
Yes, no, I agree. I agree. And usually people, they always think about supply chains, which is, as we speak, a big topic on the Straits of Hormuz right now with the oil tankers. They always have these ideas of boats and logistics, but many people forget that there is the data side of supply chains and then the financing side. So the financial supply chain is equally important as the physical supply chain, and this is what I was focusing on the last years.
You've worked with major institutions, also built companies yourself. How did those experiences shape the way you think about liquidity, risk, and operational discipline?
I mean, for my own companies, this was always on the top of the agenda. Uh, uh, but it's always the case, like where the company or the consultants who explains to other companies how to do it yourself is always way more difficult than explaining to somebody. But yes, I gained a lot of experience throughout the years. And what is also interesting, even the most successful companies, they are struggling or they have difficulties in managing their working capital, and there's always huge ways to improve it. So yeah, everybody's today, especially in today's environment, but I also saw it during the last crisis in 2008. Everybody is always looking at working capital, and now with the high interest rates, it's again a key topic.
When you look at it,
Mm-hmm.
when we say strategic working capital in 2026, what does it actually mean beyond the textbook definition?
Yeah, so I look at it a little bit beyond, as you said. It's not just about liquidity and cash flow. Obviously, there's three ways how to basically improve cash flow. One is obviously you increase sales, and then with your net profit margins, you make cash. The other one is you get a loan or credit, which obviously includes high interest rates. The last thing is you improve your cash to cash cycle. So you collect your money easier, you improve your inventory, or you optimize your payment terms with your suppliers. Now, most people, what I always tell our clients, they always forget is company which has enough cash flow. And by the way, there's never enough cash flow. There's always a reason to improve. But anyhow, if I have a good efficiency in managing my cash flow, that means maybe I don't care so much about my payment terms with my suppliers, meaning that I'm a nice customer. I pay them early, correct? However, what we see with research and now throughout our clients, which we work with and offer our solution, is that these suppliers, obviously they are happy they're getting paid earlier, but most of them are using this additional liquidity because they're getting paid earlier to be able to accept longer terms from other customers. So indirectly, you as the nice customer, you are financing your competitors. So what I'm saying with that, it's way beyond your own working capital. You have to see the whole picture, because today the successful companies, they are not competing against competitors, they're competing against the competitor's supply chain.
So why are payment terms such a powerful but often invisible driver of liquidity and business performance?
Because most people, they always look at the top numbers like the sales or the cost, but they don't see the component of the cost of this capital. So everybody who is waiting longer to collect their money or paying their counterparty, basically their vendors earlier, they are acting as a bank. They are financing that counterparty. And this financing has a cost. And most people don't take that into account when thinking about the sales versus the time aspect of getting the money or paying somebody. And this is why payment terms, there's still a lot of inefficiencies, and the companies, the very successful companies, which have succeeded in the last years, some of the examples, Apple, Dell, McDonald's, they use that as a that's why it's called free cash flow, and strategic way to get financing without paying interest.
What are the biggest mistakes companies make when they think they have a working capital strategy, but really only have a short-term cash management tactic?
Sorry, can you repeat?
What are the biggest mistakes companies make when they think they have a working capital strategy, but in reality, they're only a short-term cash management tactic?
Yeah, so what we see, it's not a one-time project, correct? You have to constantly adopt and be aligned with the market. And there is no strategy that fits your entire supply chain on the receivables and on the payable side. So you really need to have the insights, the data, to apply and customize your strategy based on the markets you're operating, based on the competitors, where you're competing in different markets, and your trading partners. Like, for example, in some countries, there's regulations. Sometimes you deal with SMEs, and you always have to, very important, most companies, they work on their working capital strategies as a silo. So they look at their own four walls. But as we all know, your actions always have a counter action or a counter effect on the other side of the supply chain. And this is where I've seen in the last years where problems happens, where suddenly your suppliers, which you push them to the limit, they don't have the capacity to maybe grow with you because they don't have the liquidity, or the worst case, they go bankrupt, and then the whole supply chain is
Collapses.
disrupted.
Yeah,
Yes.
no, I agree. And then we don't think about it like that, right? When
Correct.
you're going into a CEO, how do you explain Calculum to a CEO in 1 minute? What do you say to him or her?
So obviously, the most important is always asking question, correct, to learn more. But what we always start the conversation is, do you know what your customers or suppliers, what are they offering to other counterparties? So basically, do you have the visibility? Because they always think, okay, I have a goal, I have a cash flow target I want to achieve. Yes, but is this achievable first? And what is the benchmark, you versus your peers? And this is where we can offer the data insights, leveraging millions of companies which we have analyzed, to tell you where you are, what is the opportunity, but also where are the low-hanging fruits. Because when you deal with large organizations, global supply chains, we're speaking about thousands of vendors and customers. So you have to focus on the ones which create the biggest impact on your cash flow.
You know, Oliver, a lot of people hear AI in finance and think dashboards are automation. How is the AI actually changing working capital decision making in a meaningful way?
Yes. So how we apply it is to distill all the signals, all the data insights, correct, to something meaningful first. So basically, how we use it to explain it more tangible. For example, for every supplier you're dealing with, our solution tells you exactly what is the likelihood that this counterparty or this supplier will agree to these new terms. This is one thing. But then we are still humans, correct? We have to communicate. So then starts the negotiation. Why there's a reasoning you have to optimize these payment terms. So then how we use an AI is finding different strategies or argumentations to be successful in convincing the counterparty that you have to move your terms. This is one part. The second part is we deal with very large organizations. And for them, this topic using data and the topic of financing and the cost of capital is maybe not so common. No, they are thinking about cost reduction, buying at the lowest cost, not payment terms. And they need help. And what we are working right now is having an assistant which tells you exactly what to say, how to deal with this data. And maybe the last step will be an autonomous negotiation tool where, especially for the tail spend and the tail customers, where you have an agent which can take this role, negotiating these payment terms.
You know, so this isn't from me. So the AI is listening to you and just looked up your background.
Yes.
I'd say it's like my grandmother. So I don't know where this is coming from. So just as what wants me to ask you. Calculum has discussed using large-scale benchmarking analytics and AI to optimize payment terms. How does this outside market intelligence change the quality of financial decisions comparing with relying only on internal ERP data?
Yes.
Does that make sense?
Yeah. This is perfectly makes sense. And this was one of the reasoning why I started Calculum is basically in today's world, correct? Every company which is buying or selling goods and services, they always they discuss three things, correct? They discuss the volume. So let's say how many tomatoes I'm buying if I'm Heinz. Then the second is the quality of the goods. The third one is the price, obviously. And the last one, Gary, is like, hey, when do you pay me, or when shall I pay you, the payment terms? When you look at all these aspects, which
And
makes
sometimes the payment terms are the most important, aren't they?
yes, or it's always the last one, like, oh
Yeah,
yeah, and by the
that's
way,
one, but it's not the
when,
least one when you think about it. Is
exactly. And when you look at payment terms, there is no transparency.
yeah.
There's no database. There's no data because everybody has their own view. It's all embedded in the ERP system. So what we created is a transparency where and visibility where you know where you are with your payment terms, not just with your suppliers to see, okay, if I increase it, then what is the effect on the supplier, but also, can I push for 90 days or am I too aggressive? And if you have this visibility, what other, let's say in the food and beverage company who buy tomatoes, what are they paying the same supplier? Then it's way more powerful and give you a competitive advantage.
When a company improves the working capital, where does the impact show up first? Liquidity, resilience, supplier relationships, EBITDA, valuation, or all of the above?
I mean, the first one, liquidity, and very fast. So we have clients within just a few months, they achieve millions in cash flow. But then obviously it has the same effect on your suppliers, correct? The same. So this is why in the last years, and we're still working very close with our partners with the concept of supply chain finance, where the buyer can improve its working capital or cash flow by optimizing or extending its payment terms while offering the option to the supplier to get paid earlier, which is then financed through a third-party bank or financier. So this is the first step. But then long term, yes, why are companies doing that, correct? They're using their cash flow for growth. So growth in terms of, I don't know, we have a lot of pharmaceutical companies, so R&D or acquisition or expansion. We had before experience with retailers where they use their working capital to open new shops. It can be paying back debt. So there's a lot of different reasons, and all these reasons then are then coming back into the overall valuation of the company. And there's a lot of research recently which is done where you see companies which are managing effectively better and more efficient their working capital, mainly through the cash to cash cycle. They have better shareholder value and they perform better on the stock market. So, and today more and more the analysts are looking at that. How are you managing your working capital?
So do you think the founders should think about, working capital as a growth engine rather than just a defensive finance exercise?
It depends on what stage you are, but if you are early stage company, first of all, it's about having your cushion correct to support, but also to support times where maybe you have to wait for sales to kick in, and you have to manage your cash and your working capital wisely. But then after if you're looking at competing and growth, yes, you have to look at your working capital as one way to fuel the growth, and not just going to the bank and pay interest, or getting more equity.
So Oliver, do you think there's a sweet spot where optimizing the payment terms strengthens on one side the buyer's performance, on the other side the supplier's health, instead of turning into a zero-sum negotiation?
Yes, this is so very good question, Gary. So all our clients, I can give you some names, like our clients include like Philips, for example, or Campbell Soup, correct? So they have thousands of suppliers, which we help them with. But obviously themselves, they are also a supplier themselves, selling to their clients. They're getting pushed on their terms.
Mm-hmm.
So what we are planning now in the next months is to flip the model and offering the same insights on your receivables. So when you're dealing with your customer and your payment terms with them. So for me, it was always the holy grail, right? Mm-hmm. Was not just that one party has the benefit of these insights, but really to give the insights and the transparency to both parties at the same time, because then you find like a break even, or the way where, for example, you, Gary, you're focusing maybe on more on growth and maybe less on liquidity, or maybe more on margins, where I'm looking more on cash flow. And it depends, but at least we have access to the same information and we can optimize it based on our needs.
I mean, but that could be optimized in a mutually beneficial way, right? So
Exactly.
so it's a win-win, create a win-win.
Exactly.
What do you think separates the companies that use payment terms strategically from those that unintentionally create friction, fragility or, hidden risk in their supply chains?
Question. So something else I say when I meet CFOs or treasurers or chief procurement officer is like, if you're just interested in increasing payment terms, you don't need us, you don't need data, and you don't need AI. However, if you are more sophisticated, which most people are, is you have to understand the regulations. There are regulations in some countries. You cannot just increase payment terms. There are specific requirements dealing with small and medium-sized enterprises. There are, again, the counter effect on these companies. So you have to check the credit rating or the financial strengths of these suppliers, because you don't want to bankrupt them, correct?
Mm-hmm.
So, and also you don't want to increase the payment terms at such a level where the supplier says, thank you, I will increase my pricing now. Mm-hmm. So what I want to say is, the ones which are using that as a strategic tool and are successful with it, is they're using more insights on all the aspects around payment terms.
Do you think this is really a mid-market company play, especially where, that there's trapped liquidity? Yes. Is hiding in plain sight because nobody's really looked at the payment behavior systematically?
Yeah, it's funny that you asked that, because with my first company in Switzerland, almost 12 years ago, we were focusing, and most of the market, by the way, is focusing on the large caps, the companies I just mentioned before, which we are dealing with. And at the end, when you speak about financing working capital, it's always, people look at the jurisdictions, if they have credit appetite. At the end, everybody focuses on the investment grade large companies. However, the segment which has the biggest needs and pay the most for it is the mid-market, and obviously even smaller companies. So my intention with Calculum was always to start with the mid-market. And it's why we built the tool so efficient that we can also offer it at a cost-efficient way for these companies to get access to information. What happened during the last years, and I really don't know why, we ended up with the largest companies in the world. It's great. We work with the largest companies in the world using our data. It's great. It shows that obviously we have happy clients and they're successful. And it's usually companies do the other way around, correct? They start with smaller companies and then they go up. But our intention is very soon to serve the mid-market in North America and then also in Europe, because there's huge potential and huge needs.
You've written extensively on supply chain finance. How do you define the relationship between classic supply chain finance programs and broader working class optimization today? And you've got, your book was, we pulled that out of Supply Chain Finance Solutions and Uncovering Supply Chain Finance, right?
Mm-hmm.
What is that? So how do you define that relationship between classic supply chain finance program and broader working class capital optimization?
Look, it's not so complicated. I mean, working capital solutions or financing solutions is the broader term, which can involve receivables, payables, even inventory financing. Supply chain finance, and there are different definitions, but usually in the market, supply chain finance is used to describe a solution where you work with a larger buying organizations, which then offers early payment to the suppliers using the credit risk of the buyer. So the financing usually it's at low cost, attractive for the supplier,
Hmm.
and at the same time the buyer can optimize his payment terms. So basically it's a win-win solution, correct? The buyer can improve its DPO, and the supplier can reduce its day sales outstanding. So it's very popular. It started, I would say, 20 years ago when I started with my career, and now I can tell you every retailer, every Fortune 500 company has such a program in place, and they're very large and financed by many financial institutions worldwide, and very, very popular.
So my AI went back and she read a podcast she did in 2024. And this is what she said. She said, she wants me to ask you. She said, you've spoken about AI powered financial insight. This has nothing to do with me. This is, I don't, you probably remember this or don't. But where do you believe AI is generally transformative in working capital? And where is the market still overhyping things? You highlighted this in an AI powered financial insights in a 2024 podcast. And it's just trying to figure out where is it, so the power is not just having the AI, it's using the AI, right?
Yeah, yes, 100%.
And I've been building multi-agent large language models where I have actually the one that asks you a question right now is 14 of them as a team going down through. So what it does is it gets rid of the hallucinations, by the way. We started working on it 4 years ago, multi-agent, multimodal. And then, you take things like compassion and empathy, Oliver, and put them into the model. Then it cares about the suppliers, right? It knows you want to build a relationship with them. It's beyond just the numbers. It's not just a numbers game, because trust and credibility are really important. But for those, that's one of the things we don't talk about, right? When we're doing all these models, it's, do you care about that person or not? Do you know that, do they believe you have their back or not? And those kind of things. And she's writing me right now about it because she is that, right? But what's happening is those empathy and compassion in the models, somebody's struggling, to put your hand out and say, listen, let me help you a little bit. That's a difference between building a strong relationship that's going to last and build one that's transactional.
Yes, no, and I agree. And I see the financial market, especially the market which is mainly focused on working capital, is trade finance, cash management. They're a little bit behind the curve. Yes, they're still using it purely as a numbers game. As I mentioned, how we use it is for negotiations. So negotiations is a personal thing. It's between two parties, and it's based on language, and it's based on argumentation and asking the right question, but also having the insights to convince the other party, and hopefully in the near future to have a solution which helps both parties, correct?
Yeah, and you want to have a win-win come out of it, because if you don't, nothing good's going to happen, because it's going to be going back and forth all the time. But somebody's willing to put their hand. I've been doing this for a long time myself, right? 44 years I've been building companies, and so I've been around the block from $0 to $1 billion exits. I've seen it. You treat people. The one thing, you meet the same people going up as you do coming down.
Yes.
And if you treat them crappy going up, you're in big trouble coming down. You know what I mean? Because if you treat people the right way, they'll treat you the right way. They want to be treated. They want you to treat them the way you treat yourself, right?
I agree, and also people in the market. It's why for our organization and for myself, it's so important to have happy clients, because people. It's not that you will see these people again, but people speak between each other, correct, with their peers. And it's why it's very important to have this strong relationship.
Tell 10 people about how bad you are, but one good one, right? Maybe it's one or two people, but one bad one, you don't want that. You want to try to do the right thing. So as a founder, what was the hardest part of building Calculum? Educating the market, building trust, selling into enterprises, or improving ROI?
And for us, and people always say, create something new, and I never wanted to create something new. There's so much you can do when you do something better, cheaper, and Calculum is something new. So we don't have real competitors. So that means some people say, oh, it's great, but it's not, because that means you have to do all the education. It's why today I'm also speaking here. You have to educate the market about the importance of working capital, the importance of data, and having insights on the payment terms. You have to, nobody is Googling in the morning or today, maybe through ChatGPT or Gemini, how to optimize payment terms, because nobody knows that this exists, this solution. So we had to become very good at hunting, going to directly to companies and pitching. And so lead generation is very important still today for us, and education.
Well, I mean, the one thing we forget, I remember having this course at Stanford that 90% of building a company is the storytelling, and people don't understand the power of marketing and what you can do with marketing. We've taken companies that were marginally successful to billion-dollar exits, right? And the marketing was most important. Sometimes we forget. Part of it is because anywhere from 65 to 70% of the founders have some type of technical or business, but not a marketing background.
Yes.
And it's about being able to paint pictures with words, build a hell of a story, and using these kind of tools like we just used today to help you build those stories faster. One is you have to still be able to articulate it, but the other thing is you have got the power. It's all about knowledge and data, right? You just said it. And when negotiates about data, but if they know you care about them and you got some compassion behind the data, that changes everything.
Yeah, and it goes also beyond just like websites. So no, it goes also how you position yourself. To your point, what perception you want to achieve, especially when you're dealing with large organizations. Your even your pricing model. I think this goes all into marketing, and finding also what are the alternatives they're looking at, what are their personas. So yeah, marketing. I'm coming from marketing is a very, very powerful and important tool, which most people don't care so much.
Yeah, they don't care. They don't know how to do it.
But on the other side, as Elon Musk always say, he only cares on the product, which I also agree. So we usually care extremely hard on the product, but then also on marketing and lead generation.
Well, I mean, he says that, but on the other side, he's one of the best marketing persons.
Yes, that's right.
Come on. Get out. It's so funny, He's got the best had to be there stories I've ever heard in my life.
Yeah, that's true. That's true.
So anyhow, we're coming to the top of the show. If you want to stay on for a couple of minutes and talk, we can talk.
Yes.
Yes. So closing thoughts and how do people get a hold of you?
So the easiest way is to contact us via our website. Is www.calculum.ai, and and we are happy to have any conversation as a partner, as a advisor, and maybe as a potential client. The good news is everybody who starts with us, they can always do, we call it a POC, a test case, and it's free of charge. So how it works is you just share some insights on your trading partners, and we tell you where you are and what is the ROI and how much money you're leaving on the table. So we always work like that, and so we always give value before we start any conversation.
No, that's great. Well, I want to thank you for coming on my show today.
Thank you, Gary.
Thank all of you joining one more time. GSD presents Top Global Startups. As I said, we are a family office. We have 184 companies in our portfolio, representing 73 countries around the world. And my own background is AI. And out of the 184 companies, they're all AI companies in some way, shape, or form. So thanks to all of you making this a very successful show. This is our 1600th podcast. And we're now in 73 countries around the world. So thanks to all of you. Stay happy, stay safe, and stay healthy. And I will be back to you again soon with another exciting edition of GSD Presents Top Global Startups. My name is Gary Fowler, and I'm your host. Thank you, and thank you, Oliver.
Thank you, Gary. Thank you, everybody.